You're listening to the Cashflow Academy podcast with Andy Tanner, your source for investing made easy. Here's Andy Tanner.
Welcome to the Cashflow Academy podcast. I'm your host, Andy Tanner. This is where investing is made simple. I congratulate you for tuning in for a very special episode. It was within about, I'd imagine within 1 week, it's been about a year, give or take a week, where I had the opportunity to sit down with someone I've followed and had the chance to travel a little bit with around the world. He's the best economist in the world that I personally know, Richard Duncan, and he's so gracious to come back, 1 year after the coronavirus pandemic kind of sweeping, at least in the United States, and talk about where we are, give a State of the Union. I guess I should give a little background for those of you who don't know Richard Duncan. His bio is pretty big, but he's the author of The New Depression, the breakdown of the paper money economy, the dollar crisis, causes, consequences, and cures. He has worked at the International Monetary Fund as a consultant, and he resides in Bangkok. So incredible mind, incredible insight. And I also would encourage you, one of the things I subscribe to, people often ask me, Andy, where do you get your information? And, generally I just get data. I just want to get, numbers, PE ratios, stuff you could get on, any website, just individual company numbers. But when it comes to macroeconomics, and when it comes to seeing the big picture around the world and where things are moving, I subscribe to Macro Watch with Richard. So if you want to know what, my subscriptions are to find out this type of information, Richard Duncan is my guy. He is my go-to guy on this type of stuff. And so I highly recommend that. And with that, you can check him out at richardduncaneconomics.com. My good friend, Richard Duncan, so good to be with you.
And thank you. It's so great to hear your voice again.
And thank you for coming. Things are going well in Bangkok, I assume.
Yes, well, so we normally do live in Bangkok, but we also have a house out in the countryside up in northern Thailand, way out in the middle of nowhere. And we've spent almost the entire last year up here just trying to stay healthy and safe.
Oh, that's great.
So it's been beautiful, actually. It hasn't been a hardship. It's beautiful countryside, but it's been a different environment for us than what we're normally accustomed to.
You mentioned you've been up there trying to stay healthy. I made it almost a whole year. I caught it. It was funny. Everyone's getting vaccinated and everything, and I'm getting ready to be eligible to do that if I want to. And my son came home from school and we all got tested and bam, we all got it. So my son's had no symptoms. And for me, it was like a flu, so we're back 100% and
thank goodness for that.
Yeah. Excited to move on. And all four of us made it through just fine. And so we're looking forward to a great summer together. And boy, what a change in the world. I think one of the things that is, I'll tell you my biggest frustration, Richard, is I don't know that things are as good as people think. Now, maybe they're better. We're going to talk about the money we're printing, the MMT, how that may or may work out. Is the U.S. economy, is our GDP strong enough and our economy strong enough to deal with this? Maybe. I think if you're not in stocks right now, you're crazy with the amount of money that's being printed. But we'll talk about all those things. But the thing that bothers me most, Richard, is people will look at the numbers of coronavirus in decline, and it looks like a lot of places are going to start opening up. There's been a lot of money printed. So let's first talk about the U.S. Just exactly how much money have they created through credit and printing? What was I don't say the cost of coronavirus, but I don't know how else to put it. I mean, we printed a lot of money, sent out a lot of checks, and helped a lot of businesses and people, I'd imagine. What did you see on that?
So last year, the Fed in 2020 created $3.2 trillion. $3.2 trillion in 1 year alone. that expanded the size of their assets by 77%.
That's incredible. I mean,
and that financed 70% of the $4.6 trillion that the government went into debt last year. The government borrowed an extra $4.6 trillion last year. And so the Fed financed 70% of that $4.6 trillion in government borrowing by creating money.
And that puts the U.S. deficit at about the same. I'd imagine they're spending about 8 if they increased 4, and that probably puts their deficit at 4. I don't know. And then you have this year, they just did 1.9, and they're talking about another 3 trillion, right?
That's right. They passed the a couple of months ago now. Everything's changing so quickly. The $1.9 trillion stimulus relief, which is going to be spent, quite quickly. Almost all of that this year, with maybe $500 billion spent next year. And now they're beginning to talk about an infrastructure plan that's going to be, they say, $2.3 trillion. But that would be spread out over 8 years. So that would have a less dramatic impact on the government debt level and everything else.
These are
$1.9 trillion.
These are unprecedented numbers. At the same time, when you look at the velocity of money, that seems to be almost at an all-time low, yes?
Well, that's right. And that's because the money supply has expanded so radically.
It's harder to move that much.
So that's right. So, people think about the velocity of money as being how many times a dollar bill changes hands during the year.
In a quarter.
And, or any period, any particular period of time. And if it goes up, then people have been taught that tends to cause higher rates of inflation. If it goes down, that tends to cause less higher rates of inflation. But that's all built around the assumption that nothing else changes.
Right.
And what's changed so radically is that the money supply has increased dramatically. And that's the money supply. There are different measures of the money supply. But if we're talking about the velocity of M2 is made up mostly of bank deposits, checking deposits and time deposits. And they've shot up very radically because the U.S. government has been sending out $1,400 checks to all the Americans. And before that, other stimulus that went straight into those bank accounts. So the bank accounts shot up, M2 shot up. And it's not that the Americans are spending their dollars less frequently. It's just that there are a whole lot more dollars.
Right.
So therefore, the velocity of money, of M2, has dropped. But I don't think we should expect that to pick up anytime soon, because the government's going to continue stimulating the economy, and the M2, the deposit base, is going to continue to expand. And so I think over the coming, especially month or two, as all of these stimulus checks are actually cashed and go into the bank accounts, we'll see the velocity of money fall even further.
There's a reason at the beginning of the show, I recommended, a subscription to Macro Watch to everyone. And I think it's important for them to understand, why am I so interested in what Richard Duncan thinks, and why am I interested in macroeconomics? And I'm going to boil it down to this. Investors of all kinds, whether you're in real estate, whether you're in stocks or in business, care about inflation. And let's just look at the Fed's policy, at least in the United States. And also, you have let's not just get too small with the U.S. You have the ECB, Central Bank of Japan, China. This happens everywhere. But let's just use the Fed as an example in the U.S. is they have a target of 2% inflation. Now, what that tells me is, whether they can match that and keep it up that high, or whether they control it from going higher, that how good are they at using their tools? But that's at least their mandate or their goal. Well, if that's true, I'm going to buy real estate and I'm going to use debt to do it, because you're really setting a goal for the devaluation of the dollar at 2%. And if you do that over 30 years and it works out, you're going to have a fantastic asset that has increased in price, that rents have increased. And if you have a fixed loan, you're going to have a greater cash flow over that 30 years as rents increase. If you're a stock investor and you own Coca-Cola, and we have 2% inflation, well, over the next 30 years, a can of Coca-Cola is going to cost 2% more every single year, and your dividends, you should thrive. Your stock market is going to cost more dollars to buy your stocks. So, we're kind of fans of inflation as business owners, as real estate investors, and stock investors, as long as the inflation, isn't out of control and begins to hurt people. Deflation would be the opposite. If I'm in deflation, boy, I got to be really, really careful about what I do. And then finally, with inflation, you have a devaluation of the dollar. So how do you allocate your assets? So in my mind, Richard, what you do in terms of macro watch, inflation is a big part of this. Yes, is tracking. Is it going to go bigger, smaller? How big of a deal is that to you?
It's an enormous deal to me, because if the inflation rate were to go significantly higher, then interest rates would go significantly higher.
Right.
Significantly higher interest rates would be a real blow to the stock market in particular.
Yes.
And it wouldn't help the property market in the short run either, because then mortgage rates would also go higher. And what we're seeing
which also means demand for real estate falls. So if you can keep it consistent at 2%, you're going to be pretty happy. But if you lose control, the Fed's remedy for that is to raise interest rates, and that hurts everyone that wants to borrow money. Yes?
That's right. That hurts the economy. It hurts all asset classes generally, even gold, because the opportunity cost of owning gold, which doesn't pay any dividends, becomes higher, because if you can put your money in the bank and say earn 5% interest in a bank account, then that's not 5% that you'd be earning by holding gold coins, for instance. So yes, higher interest rates and higher inflation are very important to especially the stocks. I mean, the property as well, but stocks are more volatile than property.
Yep.
And right now, there's this extraordinary battle going on in the financial markets, focused on the stock market. On the bullish side, there is such an extraordinary tidal wave of liquidity coming into the markets.
Yes.
As a result of the Fed creating $120 billion every month. And there are also other interesting and important factors. We can touch on other sources of liquidity that are coming into the market in a very big way right now. So that's the argument for the bulls. And that explains why the S&P and the Dow both ended at record highs last night.
Yep.
But on the bearish side in the stock market, there are growing fears that there will be inflation in the months and years ahead, given that we're getting COVID under control. People can't wait to go out and start eating in restaurants and shopping and traveling and spending the money that they've saved up.
Yep, pent-up demand.
Pent-up demand. Plus, we've got these stimulus checks going out, $1,400 to most Americans. And then we're looking at more infrastructure spending from the government sometime in the not too distant future. So all of that's going to boost demand. And on the supply side, we have some pretty serious bottlenecks in terms of being able to supply enough semiconductors and various other types of commodities. So in the short term, there are serious inflation fears in the market. And that's why the interest rates have been moving up on 10-year government bonds. Mm-hmm. I once had a finance professor at business school. He said the most important number in the financial world is the 10-year government bond yield, because it affects so much of everything else that happens in the economy and the financial markets. Well, at the end of last year, it was less than 1%. It was 93 basis points. But now it's moved up really much more quickly than I think almost all financial analysts expected. It's been as high as 1.75%. And as it moved up, that caused a lot of jitters, especially in the more wildly speculative areas of the stock market. The very speculative and expensive NASDAQ stocks have had some big falls in recent weeks. But that said, the Dow and the S&P are record highs. So in this battle between this liquidity tidal wave on the one side and inflation fears on the other side, so far the liquidity tidal wave is winning this battle, and it's probably going to continue to win.
I think it's going to win. I'm more of a bearish guy for several reasons, but even with that, I think if you're not in stocks, you're going to miss a continued tidal wave. And here's my concern. We talked about this a year ago, and here we are. I mean, would you ever have thought, when we spoke a year ago, the market had just plummeted because of coronavirus? I mean, it went on sale, 20, 30% or whatever it was. Did you ever think a year later we'd be saying, yeah, we're all-time highs, and we blew past that old resistance, right? We just blew through it. You ever think that? Did you see that coming a year ago? I wouldn't have said, yeah, a year from now, this will have already not only recovered, but significantly gone higher. Did you ever think we'd be having that conversation?
I would not have made that bet. But honestly, Andy, I tell you, you can go back and look at my Macro Watch videos. What I did say is that, as I've always said for years, the government is managing the economy at the macro level.
Yes.
And one of the key aspects of that, and for the last 10 years, since 2008, has been pushing up stock prices and asset prices and creating a wealth effect to help drive the economy. Yep. Because credit growth was unusually weak and not strong enough to drive the economy as it normally did. So anytime the stock market started to have any kind of wobble, the Fed would always intervene one way or the other, sending out a message that it was going to loosen monetary policy to push the stock market back up. So I did believe that if the stock market started falling 20 or 30%, as it eventually did, that everyone should expect really, really, really radical policies out of the Fed to make sure that it pushed it back up again. Not only has it pushed it back up, but of course now it's gone much higher than it was before.
Yeah, much higher. I mean, it's not. It's almost like they didn't just
gone beyond what I would have expected, but I sure expected them to do something very aggressive.
Not just
even going so far as buying stocks if necessary to push the stock market higher.
That's what.
In the end, they only bought junk bonds.
Yeah, that's what Janet Yellen was really pushing for, to a former Fed chair to do that, and I think Japan does it. They'll buy equities, which is a really a large expansion of the Fed's powers. I don't want people to get lost on what you just said. And so I'm going to, at the risk of sounding redundant, I'm going to give a little commentary on what you just said, Richard, because I fear that people would miss that. This is the sentence that I hope everyone caught. The government is managing the markets at the macro level. Now, let me tell you why I think that statement that Richard just made is significant. Is I mentioned that, I also will look at data. I'll look at a I'll look at I'll grab like a Tesla and I'll look at its PE ratio. And the PE ratio of Tesla is probably like 1,200, 1,600. I mean, it's just out of control. That means you either believe they're going to grow, 1,600%, or you think you're going to live a long, long time to get your money back and see them profitable, right? It just is in terms of actual earnings, stocks are expensive. And that's an extreme example with Tesla, but, Amazon is high. And just the S&P in general, Shiller Index isn't perfect, but it's as high as it's ever been, except for the 90s when there were no earnings being made by internet companies or anywhere. So there's a detachment that happens, and this is why it's so important. There's a detachment that happens that once you take a company public, people can buy that stock and drive the price higher out of any reason they want aside from fundamentals. And so if I get a stimulus check, I think, well, I'll put it in the stock market. I'm probably not doing that because I've done a fundamental analysis on a company and done securities analysis. I just have money to do it. I'm putting money in there 401k wise, whether I think the market's doing well or not. There's you mentioned about other factors feeding it. 401ks feed the market. And so money goes in to buy stocks regardless. So as a fundamental analyst, a person must look at this at two levels. Yes, of course you'd want to do fundamentals on your individual stocks, but if you ignore what Richard said, this is great. Maybe the company isn't, growing their sales at the rate their stock price is growing, but you have to understand that the government is trying to prop up asset prices. So as a fundamental analyst, I'm like, oh, this is painful to buy stocks. I mean, these companies aren't making that much money. They're not doing that much better. But I have to acknowledge what Richard said if I'm going to be an investor, that look, yeah, but it's not the corporate fundamentals necessarily driving this. It's the sovereign fundamentals. Is that close? I mean, is that on track? Because that's the way I'm thinking.
Yes, that's on track. I mean, we're not living in the days of Graham and Dodd anymore, when you can just look at PE multiples and cash flows and make your decisions based on that. You really have to anticipate what the government policy is going to be and how that's going to affect all the asset prices and interest rates.
The question is there any gravity to corporate level fundamentals? As we print money and invest money, the way some people might say, well, why in the world hasn't there been inflation? I mean, it seems inherently strange that you can just print money out of nothing. And this is another very difficult dance of MMT. They said, well, we can keep control of inflation because we have the power to tax you. And if we think there's too much money out there and we start to see inflation, not only can we raise rates on the monetary side, but on the fiscal side, we can tax you and pull that money out of the economy, and we could burn those tally sticks, so to speak, right? We just burn it once we collect it from you. That scares me, not that it couldn't work, but that all of a sudden, instead of having a gold standard, something we all kind of agree on, it's massively authoritarian as opposed to a money of the people. Any thoughts on MMT and the idea how having to raise taxes to control inflation is a tool for inflation as opposed to, buying back things and sucking money out of the economy, selling things and sucking money out of the economy, decreasing the Fed's balance sheet? What about the fiscal efforts to control inflation through taxation? That's a long-winded question, but I didn't know how to word it right, succinctly.
Well, no, I understood that perfectly. But luckily, I don't think that we have to rely on taxes to control inflation. We're no longer living in the 19th century or even the 1960s and 1970s. Mm-hmm. Something radical happened starting in 1980 that has completely eliminated inflation since the early 1980s. And that's that our economy is no longer limited to what American individuals can produce.
It's credit.
And what American factories can produce. We no longer have a closed domestic economy. Now we have a global economy. Yeah. Once we started running massive trade deficits in the early 1980s, then before, like in the 60s, late 60s and early 70s, we had big budget deficits and a lot of money creation by the Fed, and that overheated the domestic economy in the United States. Everyone, there was full employment at certain times, and also full industrial capacity utilization. So all the steel factories were producing as much as they could, and all the car factories were producing as much as they could. And because we didn't buy things from other countries at that time, that led to a situation where we had domestic bottlenecks and rising inflation, both at the goods level, but also at the wage level. Because if everyone had a job, then wages would begin to go up. And particularly if everyone saw prices of cars and steels and other things going up, they demanded higher wages, and they were unionized so they could get higher wages.
Right. And
this led to a spiral of wage push inflation. And that's because we had a closed domestic economy. The reason we had a relatively closed domestic economy is because at that time we were still functioning under the system of the Bretton Woods.
Yeah.
Bretton Woods.
Yeah.
And under the Bretton Woods system, money had to be backed by gold. And so if you had a big trade deficit with another country, you had to send your gold to the other country. Mm-hmm. And because gold was money, your money supply would contract, your economy would go into a big recession, unemployment would shoot up, and you'd stop buying things from other countries.
Yeah, if not a depression. Because that's deflationary.
Yeah, and the opposite would happen in the country with the trade surplus. They would get your gold, and so their gold would expand, their credit would expand, their economy would boom, and they'd buy more things from America, for instance, and trade would come back into balance. And so trade between countries had to balance up until the time Bretton Woods broke down in 1971. Well, it took a few years after that for American policymakers to really discover what had happened. But starting in the early 1980s, the U.S. started running extraordinarily large trade deficits for the first time in its history. By the mid-80s, the trade deficit had blown out from 0 to 3.5% of U.S. GDP. And by 2006, it had blown out to 6% of U.S. GDP. That was $800 billion that 1 year alone. So suddenly we had the ability, we were no longer limited by the American workforce. I mean, now there are about 330 million Americans. Well, the global population is 23 times larger than that. And so our economy has, you could say our potential workforce has expanded by 23 times. But not only that, most of these people earn far, far, far less money than the average American worker does. For instance, 2 billion people still live on less than $3 a day.
Right.
So this has been extraordinarily deflationary. And this is the reason that inflation started dropping in the early 1980s and has fallen. Up until the early 1980s, there was a very solid correlation between increases in the money supply and increases in the inflation rate. But starting from the 1980s, that relationship broke down altogether.
That's a huge thing. That's a huge thing to understand.
It changes everything.
Yes, it does. A good example of learning that lesson is look at the subprime meltdown of 2007 and 8. And you see, I guess it was Bernanke in those days. Bernanke just has unprecedented, very accommodative monetary policy. Interest rates at zero, huge TARP program, buying up toxic assets, trying to, save the mortgage industry. And people thought with the amount, they went to that pre-80s model you just mentioned, and they said, hey, this is going to cause hyperinflation. And the silver hits $48 an ounce. Gold hits, a high level, and everyone went to precious metals to hedge. And the inflation never really happened. It rebounded in assets, but not in consumables. And so this time, it almost seems like that's emboldened the money printing. And look where gold is today. Gold, you would think, if that same thinking in 2008 was present today, you think gold would be $3,000 an ounce with this amount of money printing. In fact, what do you say about gold? What's your thought on precious metals and then maybe even Bitcoin as an investment in this environment?
So just one more word on the monetary base and inflation.
Yeah, please.
Now, if you look strictly at base money, which is a different measure of the money supply than M2, but in World War II, base money peaked at an annual growth rate of 27%. Mm-hmm. And that led to inflation, of course, because the government was spending so much money. There were price controls. But when the price controls came off, the inflation rate went up to as high as 20% mm-hmm. In 1947. So the peak rate of money supply growth in base money in World War II was 27%. In 2009, it was 109%. A few years later, in 2011 and 2013, it was 34% and then 39%. And this year, it's peaked at 59%. So we've had 4 periods in just the last dozen years or so where the money supply growth in base money has just dwarfed what we saw in World War II. Yeah. And still, the highest rate of inflation we've had at the core PCE level has been 2.6%, and that just for a fleeting moment. The Fed's favorite measure of inflation is what they call the core personal consumption expenditure price index. And their target for that is, they call it the core PCE index because it strips out food and energy prices. Right. And the reason they strip out food and energy prices is because they're wildly volatile.
They're volatile, yeah.
A year ago, at one point, the price of oil was minus $40 a barrel, right? Oil. So a year ago, prices.
Yeah, there's no place to put it, right? So you're trying to, if there's no place to put it, it's going to plummet, right?
So, and now, of course, it's recovered. So, it's not unusual to see the commodity price index up 40% one year and down 45% the next year. So there's no way the Fed could manage monetary policy if it looked and incorporated all the wild swings in commodity prices. So they strip out the commodity prices and look at the core PCE price index, and they would like for it to move to 2% and stay there. That's what they want. That's their target.
Yep.
But if you look back to the year 2000, the average rate since 2000 has been 1.7% a year. And the average rate since 2010 has been even less, 1.6% a year.
Tell me if I'm interpreting this right.
Their 2% target.
Tell me if I'm interpreting this right. When people ask me why we haven't had inflation with the extreme amounts of money that's been created, I simply tell them this. I go, because there's equal and opposing deflationary pressures. In other words, the Fed is struggling to get up to 2%, and they're fighting deflationary problems with inflationary policy to keep that balance. And it's actually been difficult for them to keep it up to 2% because there must be powers that I can see or can't see that are deflationary. In other words, a 1.7 rate, where that falls short of a goal of a 2% rate, means that there must be deflationary pressures, whatever they are, combating the accommodative policy. Is that too simplistic?
No, that's exactly right. I mean, there are deflationary pressures because of technological advances. For instance, when I first moved to Hong Kong, a 15-minute call back home to Kentucky would be, I can't remember exactly, but
technology.
Something like $100 for 15 minutes.
Yeah.
Now, not only can you call for free, but you can see the people you're talking to for free.
Yep.
So that's a 100% deflation in telecommunication costs.
And that's across the board in technology, right? I mean, technology is deflationary by nature. You're going to be able to do more with less across the board.
That's right. And then in terms of labor, well, first of all, just looking at the domestic U.S. economy, nearly 10 million fewer Americans have jobs now than they had in February last year.
Yeah.
So what really drives the inflation rate is when wage rates start moving higher on a sustained basis. Well, it seems very unlikely that wage rates are going to go up anytime soon, unless there's legislation at least that pushes them up. But with 10 million people still out of work, nearly, then we're not going to see very much wage price inflation anytime soon. And even back at the beginning of last year, when the unemployment rate was down at a 50-year low, it was 3.5%. And even then, there was no wage price inflation. The highest inflation for wages was 3.8% at the peak of that cycle. And that's not very much. And so even after we get these 10 million people employed again in the United States, we still have a global economy that we can tap into with literally hundreds of millions of people who would be glad to work at much lower rates than most Americans would be willing to do. So it's very, very deflationary. And that's what the Fed sees. And the Fed keeps saying, look, we know there's going to be a temporary pickup in inflation in the near future. Because, I mean, just the year-on-year comparison, last March and April, prices were falling. Oil was minus $40 a barrel. Well, now prices have picked up again. So when you compare oil prices this year with oil prices last year, of course, they're going to be higher. So the inflation data is going to it's going to move up in March and April. But right now, in the most recent, for February, the inflation rate for the core PCE price level was 1.4%, down from 1.5% the month before. And so this is well below the Fed's target. And so the Fed is saying, look, we don't think there is going to be sustained inflation. There's going to be a temporary pickup in inflation, but it's not going to be sustained. And they've also announced a very important change in the way they manage monetary policy. In August last year, they made an announcement. They said, look, in the past, when we thought that the economy was getting too hot and that too many people had jobs and that the unemployment rate was moving too low, we acted preemptively. We started hiking interest rates even before there was inflation, just to make sure that there wouldn't be inflation. But what we found is that the inflation rate kept moving lower and lower, and there was still no inflation. So from now on, we're not going to act preemptively. We're not going to start hiking until we actually see the real inflation in front of us in the data. And moreover, since we have been unable to push the inflation rate to our 2% target for so many years, we've decided now that our target is not 2%, but our target is an average of 2% over the long run. And what that means is since they've undershot their 2% target for decades,
let's
could easily overshoot it. They could endure 2.5% or 3% inflation for 6-9 months, even a year or two. Who knows how far they would let it run, as long as they're comfortable that all of these inflationary forces are just transitory. And the only thing that's going to make them change their mind about that is if they see a big pickup in U.S. wage price inflation. Unless that happens, they're going to view all of these inflationary pressures as transitory, and that we're more likely to move back toward a low inflation environment than a high inflation environment.
Let me comment a little bit on simplicity. My job at the Cashflow Academy, we say there's where investing is made simple, and someone new is going to listen to all these numbers and say, what the hell are you guys even talking about? So let me see if I can back this up. And these are important points. They're critical. And so I'm going to use a visual for people to try to help them understand what we're talking about, not in, all the numbers we're quoting, 1.7% overshoot, undershoot, 2%, but understand this visually. Let's just picture a big red balloon. It's just a big balloon. It's just floating there in the air, and it just seems pretty stable. And you say that's consumer prices. They're stable, right? That's that core index. The consumer prices are stable. It's not inflating, getting bigger. It's not deflating, getting smaller. It's just this tight balloon that's closed. And that's the deception of it. Now you walk over to the other side of the room and you look at the balloon, the big balloon on the other side, and you see something happening that you would not have seen had you not gone to the other side. You see at the top, in the top half of the balloon, there's a gaping hole, and there's air coming out of that balloon at a huge rate. It should be deflating the balloon. There's a gaping hole in the top. But in the bottom half of the balloon, there's an air pump labeled the Federal Reserve, and they're pumping air into that balloon as fast as they can. And so there's this huge flow of air going in and out, trying to keep it stable if you look at that side of the balloon. But a person who never comes to that side just sees this stable balloon. So the thing that alarms me is when you see that, we can measure how much air goes into that, so to speak, by looking at Fed policy and money printing. And so with the accommodative policy, it speaks to the same degree of the deflationary environment. You mentioned the global employment where you could have cheap labor. You mentioned technology. There's all kinds of deflationary pressures. Well, deflation's a nasty thing for everyone. That's what the Great Depression of the crash in 1929, the Depression was all about deflation, and that makes your dollar very, very valuable, where inflation makes your dollar less valuable. So with that in mind, here would be my plea to people, and I hate having the posture of pleading with people, but a year ago when we saw coronavirus hit, Richard, I mean, I had more people wanting to learn money all of a sudden than, you could shake a stick at. It was like, there a lot of Johnny-come-latelys were saying, hey, can I learn how to trade stocks now in 2 weeks? Can I learn this? Can I become a financial expert? Because they thought everything was going to go to hell. The thing that's scary is coronavirus is starting to calm now, and people are like, oh, okay, back to normal. Things are fine. I'll go watch Netflix and, enjoy my life. I tell you what, there's a gaping hole. There is a battle, in my opinion, between inflation and deflation that's like King Kong and Godzilla. It's a huge battle. It's really a fight to keep inflation stable. And I think that's why Macro Watch I think people would miss it. I'll bet you saw the same thing. I'll bet you had a lot of people saying, I think I'm going to start signing up for Macro Watch. Well, now it's more important today. That's my frustration. It's more important today than it was a year ago because of the inflationary and deflationary pressures are bigger. Obviously, coronavirus is deflationary, huge, but there's still tons more deflation out there that will be fought with aggressive Fed policy. So I hope, I don't know if that balloon analogy, there's no such thing as a perfect metaphor, but if you can just picture that it's not this stable closed system, that there's forces on either side of that balloon keeping it the appearance of stability. Is that okay to say? Is that hyperbole, or is that?
No, I think that's a very good way of putting it. And finally, this situation is sinking in with the economists and with government policymakers. Everyone expected after 2008, when the Fed started quantitative easing and creating trillions of dollars, and the government started running trillion-dollar budget deficits, everyone expected that this was going to lead to high rates of inflation. Even I thought that it was dangerous and would lead to high rates of inflation. And we did see in 2011 a lot of food price inflation around the world. And that led to the Arab Spring that destabilized most of North Africa and parts of the Middle East. But the next year, what happened? Well, the farmers planted more food to take advantage of the higher food prices, and the prices came back down. So what we discovered in that great experiment was that, in fact, the government could get away with running trillion-dollar budget deficits with the Fed financing trillions of dollars of that by creating money without generating high rates of consumer price inflation. And we're now going through a different episode. When this pandemic hit in 2020, the policymakers had a choice. They had two models to go by. They could choose the 1930 model, where the government really didn't do very much.
They didn't do that.
The bubble popped.
Yep.
We had massive deflation. Unemployment went to 25%. We had a 10-year depression. Europe was taken over by the Nazis. Asia was taken over by the militarized Japanese. And World War II started. Yep. Well, that didn't work out very well. And so the alternative was to do what they did after 2008, which was reflate the bubble. And so luckily in 2020, when the pandemic struck, they went with the 2008 model, and they have reflated the economy, or kept it inflated. And so our economy didn't collapse. Our banking system didn't collapse. And looks like we're going to make it through the other side of this pandemic with our economy intact. And on top of that, the lesson that more and more people are drawing from these last two experiences is that, hey, if the government, last year the government debt increased by $4.6 trillion.
Yep.
And as I said, the Fed created, what was it, $3.9 trillion. So if we can do that without causing inflation, hey, why don't we spend some money and fix our infrastructure?
Yeah.
And while we're at it,
let's cure cancer.
Yeah. Why don't we invest in
AI,
semiconductors and AI? And so there's a big shift now in thinking in Washington and the broader academic community. Is just common sense. Since we are living in this new global environment with a labor pool that's 23 times larger than it used to be, and we have proven twice that we can run the economy very hot without generating inflation, then this creates extraordinary opportunities for us to rebuild the infrastructure and go beyond that to invest so that we can make sure that we continue to have global technological dominance, which we're rapidly losing. Now, I know we've discussed this before, and I was listening to our interview from last year earlier today, and what I didn't mention then, I advocated that the U.S. government should take advantage of this new environment to invest aggressively in new industries and technologies. But what I wasn't clear about is how they could do this. They could do this most effectively through joint ventures with the private sector. And that's something that I didn't say the last time that I'd like to elaborate on a bit this time.
I think this is a salient point, because I listened to the interview as well. And I thought to myself, there's a huge difference between let me guess, because I bet we're going the same place. There's a huge difference between spending and investment. To print money to spend it and to print money and to invest it, that's really two different things, yes?
Yes. I think it's an admirable goal to have Medicare for all and free university education.
That's
for
consumption.
Everyone. That's an admirable goal. But on the other hand, if we invest on a multi-trillion-dollar scale, we can treat everyone who has diabetes, or we can invest enough so that we cure diabetes.
Yep.
And so
one is consumption, one is investment. Yep.
To cure. And the way we could do this, for instance, is, since the government has just increased its debt by $4.6 trillion last year alone, the policy that I've had in mind for many years now was to have the government invest $10 trillion over 10 years. in the industries of the future. Well, that doesn't look particularly outrageous considering that the government debt went up by roughly half that amount in 1 year alone last year. And the way they could do this would be they could set up joint venture companies with the private sector. For instance, the government could choose the most 10,000 promising American entrepreneurs and scientists and set up 1,000 joint venture companies with them, which the government finances lavishly by borrowing and money that the Fed helps to finance. And in exchange for financing these joint venture companies, the government, i.e. the American taxpayer, keeps a 60% equity stake, while the entrepreneurs and the scientists keep a 40% equity stake and they manage the company.
That makes me nervous. That makes me nervous politically, though.
When one of these companies then invents a cure for cancer, as they would just invented a vaccine for COVID, we list this on NASDAQ for $5 trillion, and the American taxpayers keep 60% of that, and we cure cancer.
Yeah, the thing that scares me most about MMT, and the thing that scares me most about that type of thing is that means that politicians are going to make these decisions. You know, crony capitalism is already a problem, right? So when you say, okay, who are those private companies going to be? Who monitors that? Who audits that? How do you keep the corruption out? The thing with MMT that drives me nuts is that now you have men and politicians and the political, you can see the political environment, why it's so deadly and so divisive and so brutal is because now if you have a bigger checkbook and if you have more freedom to do that stuff, whatever political ideas you have and ideology you have is going to be empowered so much more. If all of a sudden those guys' self-concept is, look, we can invest in whatever we want. Oh my gosh, the divisiveness between a Democrat and Republican will get even more so. Do you see a problem with that?
Here's the way I look at that. Yes, there would be some significant inefficiencies. Some investments would be totally lost.
Yeah.
Some money, no doubt, would be stolen. But if we're talking about $10 trillion over 10 years, I wouldn't care if $9.5 trillion of that 10 trillion were entirely wasted or stolen or both. If the remaining $500 billion cured all the diseases and shored up U.S. national security so that we could lock in another American century, how much corruption would you tolerate if we could cure all the diseases and you could live a healthy life for an extra 50 years?
The corruption that I would tolerate is, I think, more important than healthcare. The corruption I would tolerate is to get to AI, because China's going to get there. They got 1 billion people to gather data on with no rights. And so they can mine data, and that's what it feeds AI engines is data. And when you have no rights and no privacy and 1 billion people to collect from and investing heavily. You talk about the space race where Kenny says, look, we're going to get to the moon first. Well, congratulations, we got to the moon first. But the person that gets to AI first gains a power that is insane, or a better version of AI. And I think, you look at our debt to GDP ratio in World War II, where we borrowed and used credit aggressively to fund our own survival against the Third Reich. This is a different type of war. Can you afford to let Hitler get the atom bomb before the U.S. does, right? Does the Manhattan Project win? Because if Hitler gets the atom bomb first, history's changed. Okay, I think AI in an information age, I think you invest with reckless abandon to get to AI. But the key is it's got to be investment, not spending. It's got to be something with a return rather than just consumption.
That's exactly right. I hate to say it, but it's not exactly a war, but it is a race. It's not a race. It's an AI race.
Well, yeah, war might be. It is. It's a competitive environment. It's a competition, whatever you want to say it. Maybe competition is better war.
And whoever gets to AI first, where the machines can do everything humans can do, then from there they teach themselves very quickly to do things better and better than humans, and it all expands exponentially.
Yeah.
Whoever gets there first has the rest of the world at their mercy. We want to make sure that the United States gets there first. And right now, it looks like China's going to get there first.
That's my feeling. So,
radically accelerate government investment in AI, then we're going to be a second-rate, vulnerable, at-risk, has-been power by the middle of the next decade. And we will no longer be in charge of our own destiny. So,
no, you hit a very important point right there. The freedom's at stake. When you say being in charge of your own destiny, freedom is at stake. And it's a big deal. So that's why I feel that now, okay, great. Coronavirus was a great slap in the face to wake everyone up, but it's human nature. So many people will fall right back to sleep. They'll fall right back to sleep. When I say I think people should be in stocks, it's no longer a fundamental argument from the corporate fundamentals. It's a sovereign argument because I see this. I see the governments taking control. I'm cautiously bullish. I'm not bullish, reckless, abandon. I know men can make mistakes. We are imperfect. We could absolutely, the defining characteristic of this stuff is its unpredictability. I mean, we'll probably be having a conversation a year from now we never thought we'd have. And so being prepared and educated is why I recommend Macro Watch, why I recommend financial education, why I'm such an advocate, because information without knowledge is meaningless. Information without knowledge is meaningless. All these numbers won't mean anything to you if you have no education. So hopefully this stirs you to do this. Richard, we talked before the program. You were gracious. I think the Cashflow Academy followers, our students, the people that care, they're wonderful, wonderful people in terms of caring about this stuff. And you knew they'd find Macro Watch valuable. Last year, you gave a code out that gave them some special rates on Macro Watch. I asked if you'd be willing to do that again. You were great. Said, yeah, Andy, we could do something. Can you talk to them about how to subscribe to Macro Watch and any codes you can give them for discounts?
Thank you, Andy. Yes, so they can find Macro Watch on my website, which is richardduncaneconomics.com. That's richardduncaneconomics.com. And if they would like to subscribe, hit the subscribe button, and they'll be prompted to put in a discount coupon code. If they use the coupon code, they can subscribe at a 50% discount. And let me just briefly tell them what Macro Watch is. As we touched on earlier, our economic system has changed radically, and all the economic theory that was developed in the 19th century, when gold was money, it no longer applies to the environment in which we're living now. All of that theory was built on the cornerstone premise that gold was money. And when gold stopped being money in 1971, that pulled the cornerstone out from under the foundation of all of classical economic theory. So it's no longer capable of explaining the way our economic world works today. So what Macro Watch does is it explains how the economy really works in the 21st century, where gold is no longer money, where we have a global economy with an infinite pool of low-cost labor. And it focuses on the big developments happening in the world. Every couple of weeks, I make a new video. Each video is me making a PowerPoint presentation discussing something important that's happening in the global economy, like the topics we've been discussing, inflation and the liquidity surge that's occurring through the markets because of the Fed creating so much money, and changes in government policy, and how those things are likely to affect stock prices, property prices, interest rates, bonds, commodities, and currencies. And I do this using, normally each video is about 15 or 20 minutes long. Each one has typically 30 or 40 charts that the subscribers can download. And so if they subscribe, they will get one new video every couple of weeks for the next year. And they'll also have immediate access to all of the videos in the archives from the last 7.5 years, something like 75 hours worth of videos, including a number of courses, like how the economy really works, capitalism in crisis, macroeconomics, and a course on China's economy. So I hope they'll check that out. I think they'll find it. Some of these things that we've discussed may sound difficult when we discuss them without charts, but when you have charts in front of you, it's incredible how much easier everything is to understand. So I hope they'll check that out. It's at richardduncaneconomics.com. And at the very least, while they're there, they can sign up for my free blog.
It's fantastic, Richard. I so appreciate our friendship, and I'm trying to remember when we were together. Was it in Asia somewhere? And you were painting a picture, and you got a standing ovation. And I mean, it's just been years and years, but I've so appreciated your teaching and having you as a resource in my life, because it's very easy to become dogmatic. You know, gold is money. Well, who decided that? I like gold. I have some gold. I mean, my approach, if someone's saying, hey, what do you do? Is I'm preparing for both, trying to lean just a little bit to get ahead in leaning towards the inflation side. So as I invest, I also prepare. This is very important to understand. As I invest, I also prepare. As I see that big balloon and I see the battle of inflation versus deflation, and I see the Fed fighting the good fight so far, I'm as concerned about hyperdeflation as I would be about hyperinflation if one of those two forces gets out of control of the other. And these are not perfect sciences. And so I have investments where I am preparing for a deflationary environment, and I have investments where I'm preparing for an inflationary environment. And I need to be an active participant in my money if I want to be able to survive and thrive in what I believe is going to be a very volatile world coming up. I think we'll see more volatility in the stock market, not less. I think we'll see more sweeping changes in real estate, not less. Never a more important time than right now to do this. If you have not, studied MacroWatch, or even if you haven't, if you want to start basic, take the 4 Pillars of Investing course at my website. That's a very basic course to give you a foundation, starting to understand some of these more complex ideas. Richard, any final words for people? Would you give more of a word of hope or a word of warning to people?
Well, I think we all must always strive to be hopeful and to find solutions to our problems. I mean, too many people see that the government debt is skyrocketing and look at all the problems, and based on what they were taught in their economics courses, assume that the end is near and that we're all doomed. But I think that humans are quite ingenious, and every generation has to be responsible for resolving its own problems. And when it comes to, and I believe we can, and I believe that investors need to be practical. They may not like the idea of the government managing the economy at the macro level. They may feel that's evil or dangerous. But if they want to make money in their investments, they need to understand that that's the reality we're living in today.
Yes.
Whether they like it or hate it, that's the way things are. And they need to understand how that works. And so if they take a deeper look, they might find that things have turned out much better than they had anticipated that they would.
That is so well said. Ladies and gentlemen, I've been privileged to have as our guest today Richard Duncan. He's the best economist in my circle. He's the author of The New Depression, The Breakdown of Paper Money Economy, The Dollar Crisis, Causes, Consequences, and Cures. His website is richardduncaneconomics.com. Richard, thank you so much, and certainly love to have you back soon.
Andy, it's great having you as a friend. Thank you for having me on. I always enjoy our conversations enormously. So yes, let's do this again before too long.
Take care, Richard. You've been listening to the Cashflow Academy podcast. I'm Andy Tanner. We'll see you next time.
You've been listening to the Cashflow Academy podcast with Andy Tanner. For more information on investing made easy, go to thecashflowacademy.com.